Hello again and welcome on behalf of NAFA and the Society of Financial Services Professionals. We're glad you're joining us again today for session 3 of our Advanced Practices Symposium. Again, welcome. I do want to thank our sponsors who continue to make a difference in allowing us to bring such wonderful programs to both the Society and NAFA. I want to thank Pacific Life, Mutual of Omaha, and Beacon Financial. I also want to reference for continuing education. You recall we did send out in advance the email for those participating in the states of South Carolina, Virginia, and New York. That information again has been distributed via email. We'll go ahead and introduce our next speaker for today's session. I do want to introduce and welcome Andrew Rinn to help us sort out the complexities of multiple generations of this family and family-owned business that we've titled The Feldmans. Andrew Rinn, JD, CFP, CLU, CHFC. President of Advanced Markets and Case Competition at Emeritus. He leads this team, which specializes in being the single contact for comprehensive education, competitive product, and concept needs for today's financial professional. His background and expertise is vast, focused keenly on wealth preservation, estate planning, business planning, and executive benefits. Andrew is a frequent speaker and has authored articles for Life Insurance Selling, Senior Market Advisor, National Underwriter, AALU, and the Journal of Financial Services Professionals. Andrew has been a member of both NAFA and the Society for many, many years and has served as chapter president for the Des Moines Society of FSP and also on the national board as a director for the Society of FSP. As I introduce Andrew, I will mention at the bottom of the screen you have an option for Q&A, and we'll manage the question and answers by using that feature. And we will allow a few minutes following Andrew's presentation to address some or all of the questions. If we can't get to them, we will follow up appropriately. So with that, let me introduce again, Andrew Rinn.
All right, Rob Wellendorf, thank you, my friend, for the introduction, and welcome everyone here today to this joint endeavor between SFSP and NAFA. So I want to thank both organizations for putting their heads together and putting on this 3-part series on what we call the Feldmans. Kathleen Bilderbach, Ron Lee, my cohorts in crime, did 1-hour presentations the last previous weeks on what we call G1 Generation 1 and G2 Generation 2 of the Feldman family. So it's bestowed upon me to go ahead and finish this up and talk about Generation 3, issues and solutions with the Feldmans. So, you know, the question I've gotten so far as Kathleen and Ron have kind of presented the last few weeks is how many more issues are we going to have with this dysfunctional family? Oh, there's quite a few. We have barely even scratched the surface. So, and that's what today is going to be all about. We're not going to be able to go ahead and solve every issue for this family that has this family business, Synergy Inc., but we're certainly going to address at least 3 of them here today, which I think you'll find the solutions relevant, pertinent, and a little bit unique. At least that's my hope. So let's go ahead and move on from here and see where we're at here. Past the disclosure, I think that would be good. And just so you know, because this is for CE, we need to ask some polling questions just to make sure everybody's watching, interacting, and participating, if you will. And so you'll see these sprinkled throughout the presentation. Here's the first one. So, what happens to the federal estate tax exemption amount in 2026 under current law? A, is it reduced to an amount equivalent to the Pre-Taxpayer Relief Act level? B, reverts to the 2017 level as adjusted for inflation. C, it's equal to the calculated average resulting from the 5 highest state estate tax exemption amounts. Or D, none of the above. You should have the box in front of you where you can go ahead and choose A, B, C, or D. And we'll give you a moment to go ahead and think about that and pull that up. Okay. Andy, are we getting some of the answers in yet? Maybe we could see how people have answered here. All right. A, reduced to an amount equivalent to the Pre-Taxpayer Relief Act. I think I got you guys. Actually, the answer is going to be B, reverting to the 2017 level as adjusted for inflation. So we still got a little more than a third of the respondents answering that correctly. So congratulations, nice job with that. We'll close with that, and let's get into the meat of this presentation here today and move on to our next slide if we can. Okay, so 3 primary issues going on here, and I believe the fact pattern was sent out in advance, but I'll kind of review a little bit of the facts as I go into each solution or strategy to kind of help paint the picture a little bit. So 3 issues here. So we're looking at generally issues involving Abel. So Abel is Jack and Diane's son. Jack and Diane are the patriarchs of the family, owners of most of the family business. Abel is the sales director. And let's just say he's had some issues with commitment. So we'll discuss that in just a moment. So we're going to talk about estate equity. How can we have children from Abel's previous relationships / marriages get an equal inheritance? How's that possible? We'll look at that. We'll also look into what I call the Maria dilemma. So Abel went ahead and married a non-citizen spouse. What issues come up with non-citizen spouses? How does that affect planning? We're going to touch on that. Then finally, we're going to hit on executive compensation and business transfer / buyout. Crafting a transfer to Hunter, the precocious young man who is a big part of Synergy. How can we put a golden handcuff on him to keep him around the business? That's really going to be the key for that third executive compensation point that we're going to be hitting. So let's go ahead and move on from there and see where we're at. So this slide can be a little intimidating if you're not familiar with estate planning, and I don't want it to be, but I thought I'd just throw out the 3 general techniques, ideas, strategies, if you will, that we're going to hit here today. One's called the Q-tip. Then there's another technique called the QDOT. And then we have something called split dollar / buyout. Now, Q-tip and QDOT, all those are acronyms, if you will, for 2 very flexible estate planning techniques. They've been in the toolbox of estate planning attorneys for a number of years. It's something people might not be as familiar with as they should be, so we're spending a little bit of time here today to kind of go into that. So Q-tip stands for Qualified Terminable Interest Property, and QDOT is Qualified Domestic Trust. It's not important that you really understand what the words stand for now, but just know that they're acronyms, and we'll talk about it in a little bit along with split dollar. So let's move on from there and see where we're at. So, if it wasn't for Abel, we can get to our third technique, the business transfer executive bonus buyout for Hunter. But Abel has caused a lot of angst for the Feldman family. He doesn't work interpersonally very well within Synergy, but he's a great recruiter and brings in great clients to Synergy. So the rest of the family kind of has to put up with his shenanigans, if you will. So how do we solve the Abel dilemma? Well, Abel is on his third marriage now. May or may not be the last one. So, and his kids, Chrissy and Jacob from the first marriage, are rightfully concerned, worried about where they fit into the equation. Which one of Abel's spouses is going to go ahead and use up their dad's inheritance, leaving them, little or nothing. Jacob and Chrissy at this point really don't have a stake in the family business, so they're really relying on their dad Abel essentially to, make it right and have a some sort of cohesive estate plan, if you will. So let's back up a little bit. We're gonna go back in time a little bit. So right now, Abel is married to a non-citizen spouse, Maria. We're going to talk about that in a little bit, but before we do that, we'll talk about his second spouse. All right. So her name was Miranda. He must like the M names. And so Jackie and Chrissy were dismayed after the first marriage didn't work out for the dad, to see that he had decided to go ahead and marry Miranda. Now, Miranda's 15 years Abel's junior, and frankly, not that much older than Jacob and Chrissy. So they were a little bit concerned and worried for obvious reasons. The biggest concern being, what if their dad passed away and Miranda got the entire inheritance, and or God forbid, remarried herself, somebody that's her age or even younger, and they didn't see themselves as part of the estate plan per se. If that happened, they were very much worried about that and very much concerned. So what Abel did, and again, we're going back in time just a little bit, is he got together with one of his great estate planning attorneys, Kathleen Bilderbach, for example, one of our great attorneys out of St. Louis, and knows a lot about this technique. And what Abel said is, what, Jacob and Chrissy, my kids, have a legitimate worry. Is there some estate planning technique where I could take care of Miranda and also take care of my kids at the end of the day? Is there something we could do, in effect, to protect their inheritance? What can be done now? What's been done so far, and what could be done going forward? Those were really the issues that they decided to go ahead and talk about. So let's see what's going on next here. Let's talk about how this technique, the Q-tip, thanks for popping that up, can solve this potential dilemma that Abel seems to have with Jacob, Chrissy, and Miranda, his second wife, second spouse at the time. All right, let's move on. So this is the cast of characters, if you will. We see Abel there. Now, he's still with us today because I have a whole other technique to talk about. This is, again, is going back in time. So what Abel ended up doing is engaging in what I like to call a control from the grave planning technique. That's what this Q-tip essentially does. What this technique allows you to do is ultimately control who receives the property, namely children, sometimes grandchildren, but at the same time reserving access to a surviving spouse. So under this sort of an arrangement, this Q-tip arrangement, if you will, the executor has to make an irrevocable decision, an election on the estate tax return to utilize a portion, it's usually not all, a portion of the unlimited marital tax deduction to fund this trust. And most of you probably know this, but one is generally allowed what we call an unlimited marital tax deduction. They could give an unlimited amount of assets to one spouse free of transfer taxes. So we're simply using that provision of the tax code, which is already out there, to fund this Q-tip trust. Now, a Q-tip trust works a little bit differently. It's a little bit more, arguably nuanced than just simply transferring assets to a surviving spouse. So that's what we're doing here. We're setting up a Q-tip trust. This has to be done by the executor. It's irrevocable upon death. Generally, how this works, as I mentioned before, Miranda in this case if this would have worked out, would have been given lifetime access to all income generated from trust assets by using this trust election. So she, in effect, along with any other assets that she would inherit outside of the QTIP, she would in effect be taken care of from a financial standpoint. So the end of the day, and this is what our friends Jacob and Chrissy were the most concerned about, the trust corpus, the principle, if you will, that's preserved for them, for the beneficiaries. So Miranda, lifetime access to the income. At the end of the day, because this is a second marriage situation, this is a great technique to go ahead and provide a distribution later on, let's say at Miranda's death, to the two kids in this particular case. So that generally works out pretty well, especially when there's no familial relationship going on between the Abel in this particular case, Miranda, and the respective kids. Very common technique. Let's move on from here and look at this in a little more detail. So in this particular case, Miranda is going to be out of the picture. So what happened in this particular case is those two had a falling out. They went through the gyrations of putting through this whole Q-tip technique, worked out really well. Jacob and Chrissy were happy. They got a great estate planning attorney. But at the end of the day, they broke up. So they got a divorce. The marriage more or less ended. So this was much to the relief, believe me, of Jacob and Chrissy, who really never liked Miranda to begin with. So they saw her as a threat to the family, a threat to the business, a threat to their inheritance. So as clever as this technique was, thank God it never had to come into effect, because the two had a divorce and a falling out. So Jacob and Chrissy are essentially at this point saying, thanks, Dad. You made life a lot easier for us. Let's move on. All right. So before we kind of move on, there was only a brief period of time before Abel had a family gathering, if you will, and invited the entire family and announced in front of them, right in front of Jacob and Chrissy, that he was actually entering into marriage number 3. And this was to a non-citizen spouse. Her name is Maria. Now, Maria is from the island kingdom of Montoya. That's a fictitious name. The point of the matter is she's a non-citizen spouse. So we're looking at marriage number 3. The Q-tip was not effectuated, but we got a problem here. Jacob and Chrissy are back to being a little bit concerned, a little bit worried. What happens to their inheritance at the end of the day? Now we have an individual that they didn't know, just like Miranda, that seems to pose the same issue. And like Miranda, Marie is significantly younger than Abel and just barely older than his kids. So they were kind of astonished to figure out what was going on here. So kind of what do we do now? What technique are we worried about? Now the kids had a big worry. Marie would inherit the assets from their dad and essentially leave the country, and their inheritance would be gone. But guess who else has that same worry? Uncle Sam. So Uncle Sam is also worried that if a non-citizen spouse inherits assets from somebody that's a U.S. citizen and domiciled here, Uncle Sam will not get his share of the tax revenue. So that's also a potential issue here. So good news is there's another Q technique, that QDOT technique that I alluded to earlier, which I think can save us here, which I think can provide us a little bit of an out. So the kids are saying, what now, Dad? What do we do? What technique out there is going to help us get out of this situation where we can still get our inheritance and not have to worry about adverse implications of what's going to be happening with the estate? All right, let's move on. So this is where the qualified domestic trust comes in. So you cannot use the unlimited marital tax deduction So kind of note this down when it comes to a non-citizen spouse. I just got done speaking about the unlimited marital tax deduction, which you could generally use with the surviving spouse. And I was leveraging it in my last case scenario with a Q-tip. So forget that part of the rule. With a non-citizen spouse, it doesn't quite work the same way anymore. So part 2 of the Abel dilemma is, what do we do about Maria? What do we do about this next situation? So let's explore that. Let's explore what's going on with Maria. So she's a non-citizen spouse, as I mentioned. Her domicile appears to be in the US. Just kind of a side note, we're not going to test on this per se. When you look at domicile from a tax standpoint, it means something different than residency. So what domicile means from a transfer estate tax perspective is kind of subjective criteria. There's things that you have to look at. So legal address, where one has a doctor, a dentist, orthodontist, whatever the case might be. Business relationships, checking accounts, savings accounts, investments. So it's a little bit more of a squishy sort of a definition. Nobody's questioning the domicile of Maria. After all, she's here in the US with Abel. What is not disputable is the fact that she's not a US citizen, and what can't be disputed is the fact that this unlimited marital tax deduction is in effect going to be unavailable. We can't do something like a Q-tip technique that we just talked about. So that's what I want to hit. One other side note, and this just might come in after I hit the QDOT technique. For non-citizen spouses, they may be the recipient in 2020, and this is indexed every single year, of a exemption amount. Some people call an exclusion amount. You can give annual gifts to, in this case, a non-citizen spouse equal to $157,000 in 2020 a year. So you could still do that even though you don't get the unlimited marital tax deduction. It doesn't work in the same way, and the unified credit works in a slightly different way as well. But that 157,000, keep that in mind. We're gonna return to that just a little bit and figure out a way to leverage that annual gift from every year and engage maybe another technique above and beyond just a QDOT. So I want to throw that out there. So let's explore this time-tested technique called a QDOT. Break it down, figure it out, explain how it works. All right. Our good friend Abel. All right. So, and Maria. So let's say they have they've married. All right. So they went ahead and got married, and Chrissy and Jacob are going back to their estate planning attorney and going, you know what are we going to do with Dad? They, bring Abel along, bring Maria along. They try to figure out what's going to work here. So the attorney suggests the QDOT technique, something that's been a part of the Internal Revenue Code for a number of years. And, everybody looks at each other kind of quizzically. What does this possibly mean? So the attorney goes ahead and kind of breaks it down in the following way. This is a sort of trust that kind of represents an exception to the general rule that the unlimited marital tax deduction is unavailable when the surviving spouse is a non-citizen. And so there's certain requirements to be able to go ahead and still use that unlimited marital tax deduction, but in a different way. So with a QDOT, if you're going to set this up and still be able to fund it with a portion of this marital deduction, there are certain hurdles, if you will. One of those hurdles that you have to talk about is the fact that it's an irrevocable election. So the executor is going to go ahead and make an election to go ahead and fund this qualified domestic trust, and you can't take the money back. Most of the listeners here today might be familiar with irrevocable life insurance trust, and you can't take the life insurance policy back. Kind of works the same way with a QDOT. It's not a perfect analogy, but know that essentially there's nothing, there's no recourse once the money goes into the trust. So irrevocable. Secondly, and it's kind of an administrative thing, but not an unimportant thing, the trust must have at least one U.S. trustee. So a guardian, if you will, of U.S. origin to ensure that any kind of disbursements from the trust are annotated and tracked. And there's a reason for that. We're going to talk about that in just a little bit. But for now, know that you need to have a U.S. trustee. Third, any kind of distribution or withdrawal from that QDOT trust is going to be subject to estate taxes. So this is where Uncle Sam, if you will, the government gets their money. So if there's any kind of lifetime distribution to Maria, any kind of distribution at her subsequent death to the beneficiaries of the trust itself, the money in effect has to be subject to the estate tax. What estate tax is it exposed to? The deceased citizen spouse's tax rate, ABLE's. So you can see that these monies are being taxed if there's any kind of distribution. So at death, this trust could be funded. Money coming out of it has to be taxed. That's one of the reasons you want to use a U.S. trustee. I'm simplifying this just a tad, just to kind of get through the major points here. There is an exception. I'd be probably remiss if I didn't get into it just a little bit. There's an exception. You could take a hardship distribution. Maria could, once this trust is funded and Abel's passed away, and that would not be subject to the tax. So there's different requirements to get this hardship distribution, which we'll probably hit at another time if we have time, but know that there's some limited exceptions as well. So this is a qualified domestic trust. It's the other QTIP trust that we talked about. It's a way to, in effect, use part of that unlimited marital tax deduction to provide for non-citizen spouse. The beneficiaries of the trust could again be Abel's kids, Chrissy and Jacob. And the government gets its tax revenue, its slice of the pie, if you will. Again, work with a qualified estate planning attorney to be able to go ahead and engage in this technique. I think the situation is going to get a little bit better because some of you might be wondering, this is great stuff, but where is the financial product sale? So let's explore that next. What if we paired, like wine and cheese, a QDOT with a life insurance policy? That could be done. In fact, it's often done very effectively, very efficiently, if you will. Recall that $157,000 annual gift tax exemption amount, exclusion amount you could transfer on an annual basis to a non-citizen spouse. That's where this comes in. Why not use all or a portion of that exclusion amount and fund a life insurance policy on Abel's life? That life insurance policy can be held within an irrevocable life insurance trust. Let's move on to the next slide and show how that works. So, Eyelet to the rescue here. The donor in this particular case, Abel, owner beneficiary, is going to be a trust. So we're going to have this in an irrevocable life insurance trust. That $157,000 could be gifted and or used to fund the trust. The insured happens to be Abel. The owner beneficiary happens to be the trust. The trust beneficiaries happen to be Jacob in this particular case and Chrissy. We could have also put Maria in there as well if we would have wanted to. I guess I wasn't feeling overly generous after doing the QDOT to include her in this as well. But just know that $157,000, which is essentially tax-free, could be used to equalize the estate and provide another form, another opportunity to take care of other parties. These other parties just happen to be Abel's kids. So we've used the same picture for everyone, but their smiles seem to be a little bit brighter in this particular slide. So they're very happy about that. Just know that this is a great technique. Sometimes it can be used in lieu of a QDOT as well, but I often see them paired together. All right, so that is the eyelet technique. Let's go ahead and move on from there. Oh, a wonderful poll question. All right, so what are the primary advantages of an eyelet, an irrevocable life insurance trust? They are to remove the life insurance death proceeds from the insured's gross estate, provide the grantor the ability to control assets from the grave, both of the above, none of the above. Go ahead and vote. We'll give it half a minute. Okay, Andy, what do we got for some answers here? So 26% said remove life insurance death proceeds from the insured's estate. 16% provide the grantor ability to control trust assets from the grave. And yes, both of the above got the majority of the answers. Congratulations, audience. An irrevocable life insurance trust does both of that. Essentially lets you control assets from the grave. At the same time, can completely, if drafted correctly, remove those death proceeds from the estate. Very nicely done. Okay, I want to make sure we get in this last primary technique before we open it up to questions. This is the one I'm selfishly the most excited about to present. I mean, the last two techniques have essentially been taking care of Abel and his problems. Here, we're talking about something really new and innovative, a way to keep Hunter, that precocious essentially young man in his early 20s, around Synergy and a major part of the business going forward. Both Sheldon and Patty, obviously Abel, are big proponents of that, as are Jack and Diane. Hunter has gotten overtures from lots of different businesses because he's been so good, just like Maya was last week that Kathleen was talking about, to possibly work other places. So how can Synergy keep him together? And unlike Maya from last week, Hunter might want an ownership interest in Synergy since he has family. So let's talk about executive compensation and buyout. Let's move on. All right, this is Hunter. He looks like a hunter. So dual executive reward. All this is, for those of you that are wondering, dual executive reward is just a marketing name for an endorsement split dollar technique, which I'm going to be describing very shortly. Some of you might be familiar with split dollar, and unfortunately, we don't have tons of time to go into that. But no, essentially what this is a way of sharing a life insurance policy, generally between an employer and employee. It can be used within the context of estate planning between a corporation and or an owner and an irrevocable life insurance trust. We call those either endorsement or non-equity private split dollar arrangements. That's not what we're talking about here today. Thank God. We're just talking about a basic endorsement business arrangement between an employer and employee. In this case, as you can see from the slide, it's between Synergy and Hunter. And what we have are essentially two agreements, if you will. One agreement is what we call a bonus agreement. So what this is a promise between Synergy and Hunter. It's a contractual arrangement where Synergy says, you know what, Hunter, if you stick around for a certain period of time, we're going to give you a bonus amount of X, a monetary amount. And that could be essentially any amount. And that's one agreement. The second agreement for Hunter in this particular case is an endorsement split dollar agreement. Essentially what that is, that's where the employer, Synergy in this case, is what we call the nominal owner of the life insurance policy. They have legal rights to the life insurance policy, and they'll endorse some of the death proceeds over to Hunter. To be more specific, those proceeds have to be split, if you will, in the following way. Synergy is going to be owed, because this is an endorsement split dollar arrangement, the greater of the cash value or premiums paid. So if Hunter dies between now and, let's say, the end of this split dollar agreement, let's say 15, 20 years, Synergy will essentially get its money back. It's essentially key person insurance. They'll get their money back. They'll get the greater of the cash value or the premiums paid. That's going to come out of the death benefit. Hunter's family is going to get the rest of the death benefit. Tax-free. It's tax-free going both ways. It's tax-free for Hunter because he was paying what I like to call rent. He's paying tax on an economic benefit amount on an annual basis every single year. So 2 things going on here, and we'll go into a little more detail. Bonus agreement. I, Synergy, promise you, Hunter, a certain amount in X number of years. And a split dollar agreement, and endorse a split dollar agreement to take care of the contingency of Hunter possibly not making it to the end of that bonus arrangement period. So we're kind of covering our bases in both directions. That's why we call it the dual executive reward. Let's break this down just a little further. Next slide. So, life insurance death benefit, we just described that. As long as Hunter pays the economic benefit, that's going to be based upon, for the most part, something we call Table 2001. That's a table out there that charges a certain amount of cents or dollars, if you will, per thousand of insurance. Generally, it's a nominal amount. It goes up the older that you are. In the case of Hunter, it would be extremely low. We don't have an exact age for Hunter, but if I had to guess, he's probably somewhere in his mid-20s at the very most. So very effective arrangement. I've mentioned Kathleen's name a couple different times. She was our presenter last week. Her law firm, and she mentioned this, is actually engaging in lots of different endorsement arrangements. They've become very vogue again, endorsement split dollar agreements. So they're big. It's probably something we should be talking about more like today. So that's the next step. Let's move on to the step after that. We're breaking this down. So let's say Hunter makes it to the end of the rainbow. He makes it to the end of the service period. I'm just going to make up a service period. Let's say the bonus arrangement said that Synergy would bonus Hunter $500,000 in 20 years if he stuck around. Well, that's what happens. You could bonus him that amount. What this is a deferred tax deduction for the employer on their books. It's a deferred tax deduction. For those of you that have a decent familiarity with non-qualified deferred compensation, from an accounting perspective, it works much the same way. On the other hand, a Hunter, when he gets this bonus amount, will be the recipient, in my scenario, of $500,000. That's going to be taxable to him. There's really no way around that. So, but it's no worse and no better from how non-qualified deferred compensation is taxed. You'll see a little thing below you here. It's called tax deductible bonus 2.5 months. What does that mean exactly? What does that mean? Well, the way I like to describe this technique, it's the dual executive reward is kind of plays in that middle ground between an executive bonus arrangement and a traditional deferred comp. With executive bonus arrangement, most of the time with executive bonus, you're going to have the employee, the Hunters of the world, own the life insurance policy. And the employer simply can be making bonus amounts, typically on a periodic basis. They're going to be tax deductible, as long as the compensation is considered reasonable. Bonus amount, executive bonus is very common in the industry. We hear about it all the time. The pushback I hear about that sometimes is we're giving up control. I hear that from the employer. I don't like the employee owning the life insurance policy. I want to own it. I want to own the executive benefit. Now, there's things you could do with executive bonuses. You could put restrictions on them. There's arrangements called REBAs, restrictive executive bonus arrangements, where you could essentially prevent the hunters of the world from being able to access the cash values using the life insurance policy to collateralize a loan or things of that sort. But at the end of the day, a lot of us, that have been doing this presentation the last couple of weeks, we learned in law school, possession is 9/10 of the law. We learned that in property law. That's the case here. At the end of the day, a hunter can leave if he wants to. So executive bonus is great. A lot of employers like to have the control. For those employers, traditionally what they've done is they've resorted to non-qualified deferred compensation. So whether it be a CERT plan or a salary deferral plan, or lots of different iterations of deferred comp. Now, that's been around for a number of years, deferred compensation in many different forms. What most of us may know by now is deferred comp became essentially codified about 14 years ago. And what that means is there's Internal Revenue Code rules and restrictions around deferred comp. There's distribution requirements. There's penalties for non-compliance. And arguably, it's a lot more restrictive than it might have been before it was codified. Also, depending on the type of deferred comp arrangement, you might need a third-party administrator. So arguably, it's also costlier. So you have deferred comp over here, which could be complicated at times. It could be more costly. You have executive bonus over here, which is relatively cheaper, but doesn't give you the control. With deferred comp, employers have all the control they want because they would own the funding vehicle for the deferred comp. If it was life insurance, typically they would own it. In some cases, they leverage a rabbi trust, but at least they'd have a semblance of control. What this technique does, and we're kind of getting around to the 2.5-month time period, this kind of splits it down the middle. What this dual executive reward technique does, it gives you the control of deferred comp while avoiding the cost and complexity of salary deferral and CERT plans, but yet gives you the simplicity and ease of understanding of a traditional executive bonus arrangement. And what allows you to do all of this, and that's why we're attending here today, is this unique technique. And it takes advantage of an exception within 409A, and that's called the short-term deferral exception. And what that says is you can make a promise of a future lump sum over essentially any service period, could be 5, 10, 15, 20 years. And as long as you bonus out that lump sum within 2.5 months after the end of the taxable year, that the employee/executive vest in that amount is exempt from 409A. I'm going to translate that to real English, starting with Hunter. All right. So we got synergy. We talked about that bonus arrangement. We talked about how split dollar was going to work if Hunter passed away early. We could utilize that same life insurance policy to fund this bonus amount. And if we make a promise of, let's say, $500,000, as long as we bonus that amount out within 2.5 months after the end of, let's say, a 20-year time period. So let's say the arrangement between Synergy and Hunter is 20 years, and it ends on December 31st. As long as by March 15th, we go ahead and bonus out that $500,000 promise. We could use the life insurance policy again. It's exempt from 409A. This is the short-term deferral exception. It's a neat little exception. It gets you around 409A. You don't have to worry about the distribution and administrative requirements. and it's relatively simple for people to understand. The disadvantage of the technique, if you will, it's all taxable at once. It's a deferred tax deduction, but all taxable at once. That's not much of a disadvantage in my mind, because the older I get and the more of these situations I look at, next to the owner of the business, who usually has the biggest ego when it comes to a business that's typically the key employee, frankly, the hunters of the world, um, they don't mind so much getting their money and running, even if it's a big tax hit. Traditional deferred comp 409A plans, typically you vest in them and they pay 10, 15 years into retirement. But remember how deferred comp works. You are a creditor of the corporation as the recipient of the deferred comp plan, just like everybody else. You're unsecured. If that business, in this case Synergy, goes south, there goes your deferred comp. This is an opportunity for highly motivated executives to put in their service and go ahead and get their money right away. All right, let's go ahead and move on from this particular slide. Oh, great, another poll question. Okay, what's the advantage of an endorsement split dollar arrangement? A, allows employer with the deep pockets to subsidize the cost of insurance policy on a key executive. B, perfect solution to remove death proceeds from insured's estate. C, best way to confuse home office underwriters. I think there's probably some truth in that. D, splits the guaranteed from the investment component of a life insurance policy 50-50 every time. We'll give the audience half a minute. All right, Andy, whenever we're ready, let's see what the answers are. A, allows employer with the deep pockets to subsidize the cost of insurance policy on a key executive. More or less 80%. Congratulations, audience, you got that correct. This was a little bit of a nuanced one, so I thought I was going to trick the audience. B is a reasonable answer, which was perfect solution to remove the death proceeds from the insured's estate. Arguably, if structured correctly, it will do that, but the best answer is A, allows one of the deep pockets to subsidize the cost. So congratulations, audience. Well done. All right, let's move on from here. All right, so we've gone through this dual executive reward concept. We've talked about how it's essentially two agreements, an endorsement split dollar agreement and a lump sum agreement. We've talked about how it plays in that middle ground, if you will, between executive bonus and non-qualified deferred comp. But can we make this even better? Can we make it even more effective and lucrative for Hunter? Yeah, the answer is going to be yes. Let's talk about that next. All right. And all we're doing is adding just a couple arrows here. It's not too bad. One you're very familiar with. So what if Hunter wants to get a equity interest in Synergy? How much that is, the percentage of equity interest, we're not going to go into that for now, because I think really what I'd like to do is kind of talk about the concept and the idea to kind of get that across. All right, there's essentially in front of you what you'll see are two avenues for a buyout, if you will. One avenue, and again, it's something we've already talked about, it's that lump sum bonus. Remember, Hunter is going to get that at the end of the day. It's going to meet the 409A exception. It's going to be within 2.5 months after the end of the time period. Hunter will be into his 40s by that period of time. He could take that lump sum bonus into income. All right, he has to do that. And at the same time, you're going to have a buy-sell agreement with Synergy. Hunter can use some of that money, if you will, as a down payment to buy into Synergy. Now, is that going to, buy his entire interest that he wants? Maybe not. So he'll probably want to have within that buy-sell arrangement an installment note provision to kind of take care of whatever remaining equity interest of the lump sum bonus that he got doesn't take care of. So that could be a way to amplify or super leverage that dual executive reward technique even more. And if you want to even amplify that, you could do this in conjunction with an executive bonus arrangement. And this gets real easy real quick because it goes all the way back to what we were just talking about 20 minutes ago. You could do an executive bonus arrangement. Synergy could bonus compensation to Hunter. That's tax deductible to Synergy, taxable to Hunter. Synergy's feeling really generous. They could do a double bonus and maybe mitigate the tax a little bit. Hunter, in this case, will be the owner and beneficiary of a policy on somebody's life. It could be Abel's life, somewhere where we could find an insurable interest. Upon the death of Abel, proceeds can go to Hunter. Hunter could use those proceeds via the buyout arrangement, could be the same buy-sell agreement, to buy either more of an equity interest or maybe complete the equity interest that the lump sum bonus didn't fulfill before. So there's some smart things you could do with an executive bonus arrangement if you want to go ahead and do double duty and tie that into a buy-sell arrangement. So that's what the DER will essentially do for you. Let's move on from this slide. And I'm going to give you a quick summation of where we've been, and then we'll open it up for any questions. So we've talked about three primary techniques, the Q-tip, the QDOT, and the dual executive reward buyout technique, which does use split dollar. If you break these concepts down, like I think we did an okay job of today with one another, into their constituent pieces, they're not hard to understand. And more importantly, and that's why you come to webinars like this, they give you a competitive advantage when you're out there in the field trying to come up with a unique, a nuanced solution for a client's otherwise hard to solve problems. We hit two estate planning techniques: Q-tip for that younger spouse, preserve the inheritance for the kids; QDOT for the non-citizen spouse in this particular case. And the last case with Hunter, that precocious young executive that we wanted to put a golden handcuff on, but also provide him a buyout opportunity, if you will. Three concepts in about 50 minutes. All right, that's the end of the formal remarks. Shall we open up and see if we have any questions?
Andrew, thank you very much. Rob again here. Thanks. Would you speak to, please, I'm thinking about everything that's going on here. Will you speak to collaborate generation 1, generation 2, generation 3, et cetera? Just speak to your experience and advice as it relates to collaboration.
Collaboration, huge, especially amongst generations. Rob, you have a personal practice in Omaha, very successful one, where you yourself have to deal with multiple generations in business transfer planning. So I know you're gonna, the answer to this. Establishing a deep relationship with the family patriarch and matriarch is huge. Using that opportunity to get synergy with the younger family members, the G2s and G3s, and almost as importantly, getting to know the attorneys, the CPAs, the other accountants, all those centers of influence. So a family business, dilemma, if you will, as hard as it is to solve, is a ripe opportunity to go ahead and kind of engage in some of that collaborative activities that the best of us usually do pretty well in the business.
Okay, my next question, looking at current ownership, it's 80% mom and dad, 5% for G2 for the kids. Does it make sense, and I know this can get technical, but does it make sense for mom and dad to buy back those 5%? Or what are your thoughts on that when you walk into a situation that already has multiple generation ownership?
Yeah, that's a tough one to answer because we don't know what are in Jack and Diane's mind at this time. For those of you that kind of had a chance to read over the fact pattern, you know that Keegan, the family playboy, got a 5% interest in the business, and the rest of the family fears what he'll do with that at the end of the day. So in that situation, you're probably going to want to have him bought back out, remove him from the estate, perhaps leverage a life insurance policy to equalize the estate for the Keegans of the world, kind of remove that, then figure out the best way to take that, that remaining, what's now 85%, and disperse it among the family members. Patty, who's done extremely well, is probably going to be the one that I would think would probably inherit and have most of the transfer of the business to her, with Abel maybe having a minority interest since he doesn't involve himself in family affairs too much. So it's a little too soon to tell, but I definitely, Rob, I'd get Keegan the heck out of that equation and maybe buy life insurance on him.
Yeah, thank you. I was curious about that. We've been granular in the last 3 weeks and 3 sessions. However, if you zoom out, you kind of take that broader, bigger picture. There's several things that are important. I think mom and dad understanding, what are their wishes and desires, and the fact pattern said they haven't been able to fully effectuate or describe that. So the counseling aspect is significant. The other, which you focused on, and Kathleen as well, I mean, if this machine's going to be cranking out cash, we need to have some sort of predictable cash flow to even do the planning, and locking up those key people and incenting them to hang around and keep generating the cash, or as I say, pulling the levers that create the coins to fall out of the bottom. I think that's a significant area of focus.
Yeah, I couldn't agree more. And I know Kathleen did a great job talking about phantom stock and split dollar arrangements to keep the Mayas of the world around. And, like I said, some of those same things could be used for Hunter. And this is the end of our 3-part series, but maybe Jack and Diane think of maybe utilizing an FLP or an LLC and, discounting the transfer of business interest to junior family members. So, boy, I wish we had more time to talk about some of those other issues, Rob, but I'm glad you brought them up.
Same. Yeah, as Ron Lee had pointed out, we're today at that threshold of 24, 25 million, and perhaps tomorrow we'll be well above it, which opens up many of the things you just referenced as well.
That's right.
I need to mention as we wrap up, again, I'm very appreciative of the participation of all of you, and very thankful for our presenters, top notch. As we expected, you certainly met my expectations, in fact, exceeded them today, Andrew, as the other speakers did as well. I want to reference again for the continuing education, please, the participants in South Carolina, Virginia, New York, state insurance, CE, that information has been distributed via email. And with that, thanks to NAFA and the Society, and again, all of you for participating. Enjoy the rest of your day. Take care, and I wish you the best with your practice.
Okay.
Goodbye.
Goodbye.